Thanks very much, Matlo. Matlo's kindly stolen my disclaimer that I was going to give at the bottom at the start of this. So I think in all the time we've been doing this, we've often said that there's a lot of uncertainty around the outlook. And I think in the time that I've been involved, this year probably has the most uncertainty around the outlook to date. But it should also come through in the presentation, I think, how these uncertainties might influence the path that we see. So as Matlo said, we'll give you one possible outcome that we think is plausible. I guess our challenge also is how do we change that outcome? There are many aspects of it that are less positive than what one might like to see. And I think the challenge rests with us as a sector to see how we can move that. So having said that, let's start on a positive note, looking back over the past 2 years. 2 very turbulent years, if one thinks of the broader context in the global economy and the South African economy. Yet the agricultural sector thrived amid many difficulties. I think the chart on screen just shows GDP growth over the past 2 years, so in 2020 and 2021. And then the shaded area provides a combination of the two, so comparing 2021 to 2019. And there you can see agriculture right on the left, 25% growth. Compared to the next best, which is less than 5%, and the bulk of the sectors which are negative on aggregate. So I think as we venture forward and present our outlook for the sector, it's important to understand what drove this performance and how those factors might change as we go forward. So on screen now, I've just put real GDP growth in South Africa over the past since 2000 up to date, and then also over the outlook, so for the next 10 years. And there I highlight the past 2 years, which we've just seen relative to other sectors, in combination with 2 previous periods when we had strong support from global markets, which is very much the situation we find ourselves in now. The one being, of course, 2007-8, when we had biofuel coming into the agricultural space, creating new demand impetus, and then the other being the consecutive droughts in the US, which also supported prices. And you can see there the performance is quite similar to what we've seen now. If we go forward one, we should probably just note the word of caution is that the global economy has also turned down previously, and that we also saw spill into our sector. And I think if one thinks where we are at now, post-COVID, with the ongoing war and the concerns around global inflation and a possible recession, that's something worth bearing in mind as well as we look forward. So just to highlight 3 groups of factors per se that have influenced the sector in the recent past, so this past two years. You can't get away from the COVID-19 pandemic. I think we've all heard a lot about it, but the reality is it's still influencing the sector, and this is multifaceted. So initially, we had the big slump in GDP growth. We had lockdowns occurring in various parts of the world. That, of course, influenced our logistics system, caused a lot of bottlenecks, many of which we are still dealing with today and struggling to completely overcome. The other side of that is the support packages and the stimulus packages that were imposed around the world to get demand going again. And those, if you compare them to what was imposed, for instance, through the global financial crisis, they far overshadow the levels that were put back to stimulate growth in the economy. And this, to some extent, has contributed to this disconnect between supply and demand and the supply chain struggling to keep up again. As we were starting to emerge from that, of course, we had Russia's invasion of Ukraine earlier this year. Now, this is not solely responsible for much of what we see in the market, but it certainly contributed, and in many instances made matters that were already there a lot worse and accelerated some of the challenges. So, of course, it created big challenges in terms of energy, in terms of fertilizer prices, and also in terms of agricultural markets, being both these countries being major suppliers of products such as wheat, sunflower oil, etc. And then the last one I've grouped together, so we probably have a lot of factors encompassed in this perfect storm in agricultural markets, but that speaks to some extent to the 2 factors that I highlighted before, but then also to weather conditions. We saw flooding in some countries, we saw damage from things like hurricanes, tropical storms. We have droughts ongoing in other parts of the world. We have strong heat waves at the moment happening in the Northern Hemisphere, all of which influence production prospects at the moment. And then on top of that, you have fundamental supply and demand dynamics that are influencing markets. So as we look forward, there's probably 4 key factors that we can highlight how they evolve will be a big determinant in how this growth path evolves. So those are fertilizer and energy costs, shipping delays and also costs, the extent to which world prices normalize, and also the rate at which they normalize, and then domestic and international spending power for your consumer base. So having considered all that, you'll see on the projection on the chart that we foresee still some growth this year, although slower, significantly slower than what we saw in the past 2 years, much of that supported by the field crop sector. But then we see some correction. So then we see contraction for 2 years and then returning to a growth, but quite a conservative growth path over the outlook. So that real GDP just reaching again towards the end of the outlook, the sort of levels that we're seeing currently. If we break that down just into your various subsectors, so there we've just got on the chart the gross production value expressed as an index for the 3 major subsectors and for agriculture as a whole. Of course, this doesn't include costs. Costs were included in that GDP chart, but this is just revenue. And there you can see the star performer of the last 3 years, the extent to which field crop revenue increased over the past 3 years. I think that's phenomenal performance, and it's this rare combination of strong yields and high prices supported by global levels, which you seldom see in the market, but that's been really supportive to that sector. The other side of it, which we don't see in this chart, is the input costs that have also increased sharply and are influencing profitability. The other one worth highlighting then, the blue one, that's animal products. There you can see a sector that's grown fairly consistently. The last few years have not been so good with many animal disease challenges, as noted rightly earlier. And again, currently revenue is expected to increase this year, but costs, of course, a major factor. So those high feed grain, those high grain prices spilling into animal feed for those sectors. Then the last one is horticulture. That's the grey one, the one that grew the fastest historically, but over the last few years has been very flat. And last year and this year actually expected to decline. And of course, that becomes a very concerning picture if you think revenue is declining in an environment where costs are increasing. Much of this is because there's additional volumes coming into the market, but also with things like market access, logistical bottlenecks, all contributing to that pressure on revenue. So the logistical issue is coming very much from global markets. I've got 3 charts here to show you. So the first is global schedule reliability. There you can see we've plotted multiple years. If you compare the purple line, that's 2022, to, for instance, 2018-19, which is before all this chaos in the world happened. You can see how that declined in 2020 through the latter half of 2020, stayed very low in 2021. And while we have started to increase now, we're still only about half the level that we saw pre-2020. The inverse of that is the average number of days for late arrivals, which have literally doubled compared to those 2018-2019 levels. Again, it's moving now in the right direction, but we do have a long way to go in terms of reaching the levels that we were at before the current challenges. The one that's really scary is if you look at those average freight rates. And if you think, over the past 14 months, those have increased close to 5-fold. So extreme run-up in those freight rates from sort of the second half of 2020 through 2021. They are now coming down, but still very, very significantly above the levels that we saw prior to 2020. So this, of course, is a major factor for all imports and exports, but sectors such as horticulture, which derive the bulk of value from exports, it's playing a significant role. So price gains, this comes back to that field grain performance. So we saw the sharp increase in prices. I've plotted there just the FAO, the food price index. There we saw the extent to which prices have run up, particularly look at the orange line, that's vegetable oils, but cereals have run up. All of them have started turning around. If one looks at recent months, we are starting to see the situation turn. The ones that are still lagging are the livestock sectors. So meat prices still high, even though they haven't run up to the same extent, and dairy prices still high. But then, as I said, we have to consider those in combination with input costs. So on the right-hand side there, we've just plotted Brent crude oil and natural gas, which of course is energy, but also raw materials into things like fertilizer. And at the bottom, we've plotted fertilizer prices. And there you can see also the extent to which fertilizer prices have run up in the last few months. Again, we have seen them turn. Some of this has also got to do with trade and trade patterns and logistical systems starting to deal with what we saw happening in Russia. So when the invasion first occurred, we had a lot of challenges. So many countries imposed sanctions. Others did not, but then it was not necessarily logistically possible to trade. But we have now started seeing fertilizer move, for instance, from Russia into Brazil, which has also settled fertilizer markets globally down a little bit. But those have not even come close to the levels that we had before. If we move on looking at just the global economy, there we've also seen significant downward revisions in recent months. So on screen, we've got the GDP forecast as was done in December 2021, and then again in June 2022. And then you'll see the extent to which that was revised downwards. So at a global level, a 1.4% reduction in growth expectations for this year. China, of course, still maintains its zero COVID policy, and that's a key factor that's still influencing logistics and also influencing its own growth prospects, and with that also the global growth prospects. Then the war in Ukraine, which obviously has a massive humanitarian crisis associated with it, but it has also caused significant damage economically, and resulting in these reduced expectations in many parts of the world. It brings with it also elevated inflation, which has made it a very difficult policy space for central banks to operate in, because you're in an environment where growth is at risk, but you're also trying to manage high inflation expectations. And that, of course, is a very delicate policy trade-off. We have seen interest rates start to increase around the world, and we also do expect that to continue for the foreseeable future. If we then come to consumer spending power in South Africa, on screen, we've got a chart illustrating class mobility. So the blue bars, those are from previous baselines. Some of you that have been attending this event might remember the LSM classifications that we used to show. This is a measure that is no longer undertaken. It's been replaced by the socioeconomic measurement. And what we've done here is to try and relate the two to each other, at least broadly, although they're not perfectly relatable. But the key point to make is that if one looks at the history and the extent to which the share of population sitting in your lower income groups have declined from 2005 through to 2015, for instance, with a rise in your lower, middle, upper income and affluent consumer base, and then you look at the SEM for the last 3 years, you'll see that the lower income group still declined, although slower than what we've previously seen. And there's many factors that contribute to that, amongst which could also be the COVID-19 grant. We have seen a significant increase in the lower middle income group, but the concerning fact is that part of that increase is coming also from reductions in your upper middle income and your affluent group. So you have consumers shifting into the middle, whereas ideally we want to see everyone moving up into a higher income bracket. And this then, of course, reflects also your consumer spending power. Some key metrics: real GDP per capita, which declined by almost 70% in 2020, positive almost 4% in 2021, 1.3% in 2022, and the expectation on a per capita basis is around 1% growth over the outlook. So that's really not very fast in terms of our local consumer base. We've seen debt levels increase, so the gross debt value in nominal terms over the past 10 years increasing by 66%, credit application rejection rates increasing by 44%, and also your grant dependence increasing from 45% in 2019 to 53% in 2020. So all of these metrics pointing to consumers that are a little bit under pressure. The implication of that, just broadly in terms of demand, on the left on screen, we've got per capita consumption of basic food staples, in this case just meat and white maize. And then on the right, we've got per capita meat consumption. So there, I think it's quite clear if you look at the meat, the purple bar, for instance, the extent to which consumption growth has slowed over the past decade. And that remains the case in the short term. In the medium term, as the economy starts to recover and inflation gets more under control, we do see more growth there, but particularly in your more affordable meat types, so your chicken and your pork. If you look on the left-hand side, then that speaks to white maize and wheat, and there we've seen Whereas in the long term, per capita consumption levels have actually been declining. That has turned around and they've now started increasing again. And over the outlook, particularly in the short term, that's a trend that sustains before flattening off then over the second half of the outlook. So just a brief focus on the three subsectors. Now I think that's provided a bit of a broad overview and a picture, some key messages from field crops that we want to highlight. Firstly, the strong revenue gains. I think we've spoken to that already. Good yields and high world prices, but we've got good stock levels. We have had big crops. We are sitting at export parity, so if world prices normalize, we do expect our own prices to come down as well. That, of course, is good news for your consumers from a food inflation perspective, but from a producer's perspective, it implies that competitiveness will be key. With these very sharp increases in input costs, significantly increased risk for our producers. In a year like the current, where you've had good yields, that's okay, you can carry that. But of course, the risk of not having a good yield has increased significantly in this higher income cost environment. And then we expect this cycle of profitability to turn, right? So we expect profitability to come down a little bit. But the past few years have really provided the opportunity to reinvest. We've seen very strong machinery sales, for instance, equipment to do with precision agriculture, all of which then should put us in a better position to deal with it when the cycle turns down again. So just in terms of global prices, I said in the beginning, one of the key questions is how quickly will world prices come down and what extent will they come down? This is the assumption that we're working with. It's quite scary if you look at the short-term numbers, the 2021, 2022 levels. We do expect them to decline in the short term, but again, there's a lot of uncertainty around it. So just to highlight a few factors that will influence that and how it plays out. Structural demand factors such as renewable energy, this acceleration, the renewed impetus into renewable energy, particularly with the ongoing war. It's creating additional demand, particularly in the vegetable oil space. China's recovery following their ASF outbreak, so their African swine fever outbreak is a few years back now. But the rate at which we saw their pork herd recover is really impressive. And apart from that, we've also seen a bit of a restructure. So it's recovered through big commercial units that use feed very intensively, which have replaced many smaller producers that were not using feed that intensively. So the demand aspects of that with respect to feed grains is quite significant. The next one is animal health. Of course, in the short term, things such as ASF, such as avian influenza, which is happening in the northern hemisphere, are all influencing short-term supply prospects. We've seen various challenges with palm oil supply over the past few years to do with labor, to do with too much rain, to do with too little rain, many aspects influencing how optimally that product was harvested, and this was, of course, a key driver in vegetable oil prices. We've seen trade policies, as mentioned earlier by the DG, many countries responding by restricting trade, which added an additional layer of uncertainty into a market which was quite volatile already. One of those was Indonesia with palm oil, which has since been opened again. We've had numerous weather events, and these are ongoing, and I think this is probably one of the biggest uncertainties with respect to how quickly these prices come down, is how the weather plays out with the current conditions, for instance, in the Northern Hemisphere, a key concern. And then the last is stock levels and tradability. So the level of absolute stock and also where the stock is and how easily it can be traded into the global market are all key factors to consider. So I'm sure you'll agree that there's a large degree of uncertainty around all these factors, and that will influence how quickly these prices come down. What we have more certainty around is that in the medium term, we feel that they will, but we also think that they won't come down to the levels we saw prior to the current turbulence. So there's a lot of factors that underpin that, but just something like the risk and the extent of risk that will remain in the market is worth mentioning. One of my colleagues mentioned a just-in-time economy as opposed to a just-in-case economy, and I think that's very much where we're sitting at. So much, a bigger stock requirement and a bigger risk premium in the market. If we just zero in on stocks very briefly, the charts on the right now show at a global level the maize stock-to-use ratio in blue at the top, and then prices in green. And this is the point that we're trying to make. If you look back to, say, 2012, 2013, the stock-to-use ratio was around 16%, and the maize price was $300. If you look at the current year, the expected stock-to-use ratio at the end of the year is 26%, yet the year-to-date price is well over $300. So much higher stock levels, and yet prices have run up much further. And a lot of that is to do with uncertainty, but a lot of that is also to do with where these stocks are. So if one looks just at maize, for instance, 65% of that sitting in China, so there's some degree of uncertainty around that. And then in sunflower, for instance, a very big share sitting in the Ukraine. And we have seen the deal now to enable exports, but the extent to which this can be traded in the global market practically is still uncertain. Just the last point to remember, as I've noted earlier, the fertilizer prices. So this is just the outlook for global fertilizer prices. That is also coming down, but arguably a little bit slower than what we see commodity prices coming down. And this, of course, then has an influence on your profitability. So if we just look at that profitability now, this is in South Africa. We've plotted an index, a combined index of summer crops, dryland summer crops, and irrigated summer crops. You can see how those margins have increased over the past 2 years, and you can also see the extent to which they come down in that period that's highlighted in red. They don't come down to 2018-19 levels, which is, I think, important to note, and then they do start to increase a little bit from there. The other important point to make is that all industries didn't have the same price support. So these industries, your maize, your soybeans, your sunflower, they're quite well integrated into the global market. On the right now, we're showing potatoes, and that's obviously an input-intensive industry. So those high input costs having a significant impact in that industry, but your pricing is very much more determined in your local market. So it's much more of a local supply-demand dynamic. And then we see margins coming under pressure earlier because they didn't have the same extent of price support in 2022, for instance, to be able to ride out those input costs. From an area perspective, we've just plotted on screen your total summer and winter grain area. On the left, there you can see how it has increased already, and if we look at the expectation for the 22-23 season, that's actually for the biggest summer crop area in about 25 years. So that's the biggest summer crop area since basically markets were deregulated, if one looks at that projection. That's, of course, coming from the good profitability that we've seen, but if one looks forward, that also comes down again as those margins come under more pressure. Interesting also is the composition. So over time, we've seen oilseeds, for instance, making a bigger contribution to that total area. In 2010, that was 18% oilseeds as opposed to the rest being grains. 2020, that increased to 28%, and in 2030, that increased to 36%. So oilseeds playing an increasingly important role within that area base. If we just look then at relative shifts over the outlook, here we've got on screen just a change in area over the 10-year period of the coming decade, so comparing 2031 to an average for 2019 to 2021. And there you can see some normalization, for instance, for white maize, sorghum coming down again, sunflower seed coming down a little bit, and then still some growth for yellow maize and for soybeans. Of course, if one looks at production, you also have to consider your yield growth. So fairly consistent yield growth, of course, over the baseline. We know this will be volatile, but in terms of general trend, we do expect some growth over the baseline. As I said, they're all expanding in the short term based on profitability. In the medium term, one then has to look at relative profitability and also risk perceptions with respect to the various crops in terms of driving the shift between the different products. Quality of products, a major factor influencing decisions. When we've had wet years like this, something like maize, for instance, we have had some challenges with milling quality maize. Soybeans are increasingly successful in the western parts of the country. I think producers there have done a lot of experimenting and understanding the crop a lot better, and we see that reflected also in yield levels. It's also a crop that's handled the past the wet years pretty well. Sunflower is typically considered resilient in drought conditions, but of course has risks with respect to something like sclerotinia. And also in periods where production expands very quickly, often in years where rainfall is late and then we plant more than what we ordinarily would have, we see prices respond quite significantly. So I think that that market can outproduce itself quite quickly. But important to note is if one looks at that bigger picture, you know, even in sectors where the area is declining, we see sufficient yield growth to sustain production growth over the outlook period. Just in terms of where that ends up, on screen we've just got the use of the various products. So of course, you know, that composition and the channel into which it's sold also influences your demand side. So your basic food staples, as I said, short-term increasing and then stabilizing in the medium term. So we've got growth of 13% there for white maize, 14% for wheat, 16% for sorghum. Then industries that are more driven by animal feed demand, so your yellow maize growing a little bit faster at 17%. And then, of course, soybeans, which is crushed predominantly for the protein meal, that's growing at 47%. So that should be caveated, I guess, to some extent, because that's not all coming from growth in feed demand. Some of that is also replacing oil cake, which we're currently importing. And then the last one is vegetable oil. So soybeans, of course, contributing to that, but sunflower is crushed predominantly for the oil. And there we still foresee demand growth, and we also foresee that we'll see a continuation of the import replacement that has occurred over the past few years. So just the last one then on field crops. I think we've said soybeans have come out quite strongly in many of these previous charts, so it's worth just a quick focus on it. On the left-hand side there, we've got production, consumption, net imports of soybeans along with prices, so domestic prices situated within that parity band. And I think from that it's quite clear that in the short term, soybean prices have now dropped to export parity levels, and with the growth that we're foreseeing, we expect them to stay close to export parity. So you'll see that we've actually switched into being a net exporter of soybeans there. We are also processing more, as you saw from the previous slide, which means that we can continue replacing imported protein meal. So if you look at the protein meal on the right-hand side, that compares what we're producing from canola, sunflower, and soybeans to net imports of total oil cake. And there you can see that soybean oil cake production increased by 1 million tons over the past decade, and then adding another 340,000 tons over the outlook. There's always that little bit that we're not fully replacing, and much of that is going into the coastal markets. Whereas, you know, given transportation rates and efficiency to move the product from upcountry into the coastal regions, there's a time of year through harvest where it probably can occur when prices drop far enough below, but then there's other times of the year where it's cheaper to import it into your coastal markets. So if we just switch then to animal products, I think I've mentioned earlier, this is a sector where revenue is growing, but they are severely challenged in terms of profitability by these high feed prices. So the same prices supporting our grain producers are making life difficult for our animal producers. It's a relative luxury product in the food basket, so it's quite sensitive to consumer spending power, and I think that's important from a demand perspective. Which makes us then note that we'll need to accelerate exports if we really want to accelerate growth in these animal sectors. So on screen, we're just showing a look at profitability. So we're comparing here very basic indicators, so meat to maize price ratios for chicken, for beef, and for pork. We've got an international indicator in the dotted lines, and then we've got the solid line is in South Africa. So there's a lot of interesting factors that we can pull from that. Firstly, it shows clearly that revenues are under pressure, so our profit margins are taking strain there. Many of that's due to international factors, you know, all the factors that we've talked about. So we see the same trend internationally that we see domestically, which is different from an earlier period, so for 2015-16, where it was domestic factors driving up feed grain prices, and then we saw a disconnect with the global market. The good news is that these things are cyclical, and once these international grain prices normalize, we do also see that spilling into your profitability of livestock production. This is both locally and internationally, but it's important to note, given the expansions happening in China, that the equilibrium where pork prices settle is probably a bit lower relative to where our other meat prices settle. It also tells us something about competitiveness, right? So if one looks at the relative positioning of those charts, look at beef, for instance, the domestic beef to maize ratio is sitting below the international one. This is a sector where we're a net exporter. And then if you look at poultry, where we're a net importer, that's the other way around. And then pork is quite strongly comparable. So, but broadly, this is showing, particularly if you look at beef and pork, that these are sectors that can compete very strongly in the international market. If we just look forward then to the demand side, on screen we're showing the demand growth over the 10-year period for the various meat types. We've disaggregated that into what gets produced locally and what gets imported. It's clear from that that traditionally this is a market very much orientated towards our domestic consumers. But given the spending power environment, the picture that we sketched earlier for our domestic consumers, the growth is slowing drastically in that environment. So it also implies that we may have to look wider if we want to go forward. Affordability and value for money, key considerations in this consumer environment. So obviously if your spending power is under pressure, then affordability becomes even more important than what it normally is. And that's also why we see chicken playing such a big role in our meat market. If you compare the chart that just come up on screen, you'll see that 65% of South Africa's meat consumption is chicken compared to globally, for instance, it's only 37%. Broadly, we would say production growth is possible. We are still projecting production growth in these industries, even if the demand side slows quite significantly. In some instances, that's because exports can grow. Something like beef, for instance, it's growing its share of exports in the market. But also in others, it's possible to replace some imports. So you'll see for poultry, for instance, that the share of imports in your total consumption is declining over time. If we just look at those chicken imports there, you can see some of the trends over the past few years, and I think that's an encouraging picture. On screen, we're showing total chicken imports disaggregated by HS code. So if you look historically, when imports expanded so quickly, much of that was occurring in your bone-in portions, so the purple part of the chart. And that's also where we've seen them come down over the last few years. So this is an industry where we've had significant investment into expanding domestic production. The poultry master plan was finalized a few years back now. But this is also then, given those investments that have occurred, the fact that we've been able to reduce imports by 18%, we need to then make sure that those investments are sustainable. If you just break down those bone-in portion imports a little bit, I've got them on screen disaggregated firstly at the top by product. So there you can see the major products contributing to that. It's predominantly leg quarters. And then at the bottom, we've got disaggregated by country. So the same volumes. I've broken out there Brazil and then 4 EU countries, which I've broken out separately because they are the ones that are involved in the current anti-dumping duty application. Then the rest of the EU, the USA, and other. So there it's quite clear that the contribution from the EU has reduced over time. This is partly because of avian influenza in the EU. But even from Brazil, those imports have reduced over time. So this is, of course, this is where it's relevant to consider something like the anti-dumping duty, which was recommended now and has been postponed by a year given what's happening in terms of consumer prices. This is where it would typically have an effect. If we come to the outlook for the chicken industry then, on screen we've got chicken production shaded in the back. We've got chicken net imports, the bars at the bottom, and then we've got this profitability ratio, so your chicken to maize price ratio. I think some important factors to note, again, we've mentioned in all these sectors profitability is under pressure. But if you compare the current chicken to maize price ratio, for instance, to 2015-16 levels, very comparable to what we saw in 2015, but not quite at the level that we saw in 2016, which is, of course, not a sustainable level to begin with, but it just contextualizes the degree of price pressure that we see in the market. In terms of production growth, as those grain prices normalize, those feed prices normalize, this ratio does improve. And if you view it relative to the past, it's actually quite favorable over the bulk of the outlook period. This then implies that where production grew by around 1.2% per annum over the past decade, it's now accelerating a little bit to 1.7% per annum. And much of this is investments that have been made. And it's based on the premise that those factors agreed to in the master plan will be implemented. So something like ensuring free trade, something like the anti-dumping tariffs will be imposed in the medium term. Imports are expected to stabilize around 480,000 tons per annum. As I said, this is provided that trade environment is as has been announced. This largely reflects a stabilization at current levels, so not really reducing further, but not growing either, and it implies that its share in the total market will decrease over time. If we come to beef then, this is an industry that's experienced some wide swings in the past. If you just look at that beef to maize price ratio, falling basically to an all-time low in 2016 and then swinging to an all-time high in 2017. This, of course, is a combination of rising beef prices over that period. In 2016, with the drought, we slaughtered into our herd. So we had reduced supply, we had a sharp increase in prices, and then feed prices normalized quickly when we had the record crops domestically. What that has done is it induced a cycle of herd rebuilding. The cycle was probably accelerated over the past few years when we saw producers with mixed enterprises doing very well with their cash crops, with their field crops. This enabled them to hold back more, to grow their cattle herds. The reality of that is that over the next few years, that production will enter the market. And I think that's an important point to make. So over the outlook period, we're expecting growth of around 1.6% per annum, which is fairly in line with the growth rate that we saw in the past. But we have to note that if those kinds of volumes that we do expect to come into the market are to be taken up domestically, prices will probably have to decline from current levels, at least in real terms. The alternative is that we export more. So you'll see that our export projection is fairly flat. So over the past decade, we saw exports grow by around 17% per annum. Under the baseline outlook, we have that at about 3% per annum. This acknowledges, of course, that there's several constraints with respect to something like animal health. If it was purely an economic simulation, those exports would be a little bit higher. But we know that there are many factors that are prohibiting us from growing exports substantially. It's also a risk factor. So with so much risk in the market with respect to exports, if you put everything just into exports from a producer's perspective, then there's just too much risk about. Enabling faster export growth, getting animal health under control is probably one of the biggest opportunities we have in the sector for inclusive growth. It's been noted by the DG in his opening earlier, but this is a big sector. It's north of 12% of agricultural revenue, and 40% of the herd is already sitting with your smaller producers. So it's a sector with immense opportunity, but it's a big problem currently that we need to solve together if we're going to unlock that opportunity. I've spoken about animal disease, so this just puts it visually. This is foot and mouth. So the map shows where the foot and mouth outbreaks have occurred over the past 3 years. The chart shows the number of outbreaks per province, and I think it's quite a scary number if you look at how that chart has ramped up over the past 2 years. The important thing to note is I think there's a lot around FMD at the moment, and rightly so, but it's not the only animal disease that's influencing our sector. There's many others that's constraining productivity gains that could be had, and also reducing our possible export market avenues that we really need to open up. Just the last one on livestock, looking quickly at pork. So this is a sector that's grown very quickly in the past. We saw production grow at around 4% per annum over the past decade. Profitability has also come under severe pressure, probably more so than your other livestock sectors. If you look at that meat to maize ratio for pork, that's the lowest that it's ever been. Prices have not increased to the same extent that we saw in other meats, partly because our own production expanded quite significantly, but partly also because of global factors that are influencing the market. This is, as we said earlier, it is cyclical, so we do see that ratio improving a little bit over the next few years as feed prices come down. But we'll need to ride out this cycle. So productivity will be critical, and also value chain efficiency, the extent of integration in the value chain, and how you can manage your cost structure will obviously be key factors determining that. Over the outlook, we see production growing at around 2%. You'll see that profitability ratio stabilizes around levels similar to 2018-19, which induces this growth in the medium term. Imports always a part of the market with very specific cuts, but in time reducing the share in total consumption. This is an affordable meat type as well, and if one looks at price paths over the outlook, its relative affordability in the meat basket is improving, which is also supporting consumption growth. So just as the last one, to switch into horticulture, as noted at the beginning, this has been one of our star performers historically, but it's one that's coming under significant pressure. We've seen a lot of investment. We're seeing expanding volumes coming into the market now, but that's weighing on prices, and in this high cost environment, putting severe strain on margins. This is probably being made worse by the logistical constraints in terms of when it occurred. Some of them are global, some of them are our own issues that we need to solve, but they're all contributing to make the price challenges worse. And of course, from our perspective, if we want to mitigate these risks and ensure sustainability in these industries, which are all labor intensive, then a quicker opening of additional market space will be critical, and also ensuring that that is competitive. So if we just look back quickly again at fruit prices. So here we've got real prices for various fruit and nut products, export prices. In the decade preceding 2019, you may wonder why 2019. Firstly, it's pre-COVID, but more importantly, it's the period that induce the investment into the volumes that we're seeing entering the market now. So these tree crops have some lag into entering production. And you'll see the positive real price growth in most of these industries which induce that investment. If you just fast forward 2 years and you look at the green lines, which reflect the 2012 to 2021 period, that picture changes quite significantly. So many of them still positive, but much slower. And some of them already pushing into the negative. And that's predominantly because of price declines that we've seen over the past 2 years. So as I said, there's the volume entering the market locally, and South Africa, being a big player in many of these markets, is influencing prices. But it's also being exacerbated by factors like COVID, its impact on demand, like the war happening in Ukraine, and also the logistical constraints, both globally and in our own ports. The important thing to note is that these were big investments made. They labor-intensive industries, and if we're to secure these jobs and ensure sustainability, we really need to prioritize opening new markets for these products. If we just look very briefly at the impact of that investment, here we've got the past 10 years stacked in terms of area. So if one adds all these various fruit and nut products, that was 40% expansion in area over the past decade. Production's still lagging, so there we're at 29%. This is partly the effect of drought conditions, particularly in the Western Cape in 17-18, but also, as I said, trees that still need to come into full production. The big contributors to that area growth were your citrus fruits, and then also nuts, so macadamias and pecan nuts all growing very quickly. With palm fruit and citrus the biggest contributors to the volume increases that we've seen to date. If we just look very briefly at the age distribution of some of our citrus industries, so there we've got the national orchard for mandarins and lemons, and there you can see the big share that's still sitting in those young categories. So for lemons, 40% of the national orchard still below 5 years of age, which is not yet completely full bearing. In the case of mandarins, that's 56%. So what this suggests is there's more volumes coming. So we have seen some volumes enter the market, but there's still some more en route. How we see the outlook then, this is plotting the same chart again, but just over the outlook period, and there you'll see that the area projections are now very flat, so only 3% growth over that 10-year period. But then that's offset by these volumes that are already established and coming into the market. So we see production growth of around 24% if we combine all these products. Area-wise, there's consolidation in wine, palm fruit, and stone fruit. The limited growth that there is very selected for specific varieties, specific areas for table grapes, citrus, avos, and blueberries. And then in terms of volume, the big contributors there is citrus, which you've seen from those age distributions, as well as avocado and blueberry volumes. So if we just look at these sectors individually then, this is the market disaggregation. So it's showing where this product is likely to go. Both historically, it shows exports, how much went into the domestic processing industry, local fresh, and then on the right-hand side, you'll see the line in the middle, so the different coloring, those are your smaller products, so it's just reflected on the right axis on a different scale. I think the growth is clear. you know, all those citrus commodities, 50% for oranges. This is, of course, worth noting because this is the product where the new false codling moth regulations are causing big concerns for the industry. If those kind of volumes need to move into the export market, 40% of those exports are already going into the EU. So this is something that will need to get sorted out. Growth around 80% for lemons and soft citrus. And then some other strong performers, avocados growing at 88%. And then look at blueberries, 160%. So much of that growth. This is an industry that's expanding very quickly. So some of that growth has already occurred. That base period is a 3-year average. So even 2021 compared to 2019 is already much higher. And we do see area growth slowing drastically, but as prices have come under pressure. But again, those volumes are entering the market. I think the big challenge and the big picture that we want to highlight here is the significant additional export volumes that will need to go out over this 10-year period. That implies that we really need to get on top of our logistical issues and that we need to get our market sorted out. So this is just a view on logistics. On the left, we've got a map that shows where our major ports are. The numbers in the ships, if you're wondering, that's the global ranking done by the World Bank. So where those individual ports came out in terms of port efficiency. So there we challenged across the board. And they just overlaid with major production regions for fruit types. So it's giving a little bit of an indication of which fruits are going into which harbor. But I think the more important one is if we just look at total number of cartons exported over the next decade, that's still increasing by around 38%. So 38% growth in volumes. And that comes in a situation where our ports have already been challenged. So this just looks at the current season, showing weekly exports of our major fruit commodities. And all those red circles, all those highlighted interruptions there, they're from various factors. Some of them are international. Some of them were the flooding in Durban. It's load shedding. It's Transnet systems. But it's just worth noting, and I think the real challenge with this is that once we have disruptions like that, it implies that those volumes need to shift to later weeks. So now we're pushing additional volumes in weeks we're flooding our markets in subsequent weeks. And this is the imperishable product. So they've been standing, we've reduced quality, so we're not getting the same price. So we're now pushing additional volume of a product where quality has been influenced already. So the net effect of that is if we come back to the price picture, this is showing the outlook. So again, real export price movements comparing the past decade, so the 2012 to 21 period in blue, and then in green, the 2022 to 2031 period. And I think there it's worth noting that on average, products like mandarins, plums, lemons, pears, blueberries, all in the negative in terms of real price growth over that outlook period. If we just fast forward one and take a different view on those prices. On screen now, we're just showing citrus. So this is, of course, the big one. On the left is a nominal export price index, and on the right is an input cost index. So major inputs looking at fuel, fertilizer, combined indices such as requisites and intermediate goods, and then labor. So that labor is increasing over time, in line with the sectoral determination, and then after that at the upper end of our inflation band, so around 6% per year. And there you can see the impact of that. And if you think citrus, around 35% of direct production costs on farm is attributed to labor, then this paints a very concerning picture if you see that the price path relative to the input cost path. And that then, of course, raises the concerns that we were noting earlier with respect to the sustainability and the profitability of these investments and the jobs that are associated with them. So just lastly, to talk about markets, I think we've said a lot about the logistics side, but markets are also important. So our fruit market's typically quite concentrated in the EU. There we've got the different products and the share of product that goes into the EU, from 75% for subtrops to just over 40% for citrus. Why that's important is because if we look at growth, on screen we've just got now growth in our middle class population and where that's occurring in the world. So if you look at that, Asia Pacific is really where it's happening. So the EU is a very important market for us. It's a stable market, but it's certainly not a growing market. So if we need to push additional volumes, this is the regions that we need to be going into. And then if we just add to that the preferential trade agreements, the table that you see on screen we have shown before in previous baselines, but basically it just shows the major markets being targeted in that Asia-Pacific region on the left, and then at the top we've got South Africa relative to its main competitors in terms of fruit export. And then the green and red is the absence or existing trade agreement. So if it's green, there's some preferential trade agreement in place. If it's red, there's no preferential trade agreement in place. So basically it's showing just that most of our major competitors have preferential agreements and so are facing a more favorable tariff structure in these markets than what our South African producers are. So after the fruit, you might feel like a glass of wine, and I think we can do that after the presentation is finished. But I'll just end with one slide here on the wine industry. So this is of course, also a major contributor to our export base. It's an industry that was under pressure, was self-correcting. If one looks a little bit historically at those stock levels at the orange line, from 2015 through to 2018, production declined, stock levels declined, the market was getting to a better equilibrium. Prices that had been declining in real terms for many years had actually increased, investment starting to reoccur, and then came COVID. So we had the big shock with domestic sales bans of alcohol, which was obviously a big contributor for this industry. We also had some difficulties with trade, and then we had stocks running way up again to record levels, well above the problematic levels that we saw already in 2015. How producers have coped with this is to a large extent by going against the industry strategy, which is very much aimed at premiumization, so looking at packaged exports as opposed to bulk. But this high stock situation has forced them into pushing more bulk levels into the export market at lower prices. But at least it is clearing out some stocks for us. So you'll see that from 2023 through to 26/7, we do see those stocks coming down a bit. That's when prices turn, so your very flat production path over the next few years then starts to turn marginally positive over the second half of the outlook. So just some key last thoughts, some key points to highlight, all of which I hope came out in the presentation. The outlook was generated amid great uncertainty. I think we all acknowledge that, and much of that comes from global factors. So of course how those plays out will have a significant impact on how that outlook plays out. Consumer spending is under pressure, particularly in the short term in the high inflation environment. If we're to accelerate growth, we likely will need to look beyond our own market. Animal health, I think this has been raised many times before and also prior to my presentation by the DG, but this is really critical to enable productivity growth and export opportunities. Within the field crop sector in particular, where we see margins closing over the next few years, it will be critical to remain on top of the productivity curves of things like research and development, but also recent investments into top technology, into new equipment, all of which will support us as we aim to do that. I've said before, the high input cost environment has added considerable risk for our primary producers in an already volatile environment. So this is a key consideration. It also has cash flow implications, particularly for your smaller producers. Infrastructure, investment into our ports, I think that's been acknowledged also prior to my presentation, but this is critical. But not just our ports. Our ports are one aspect of that, but there's rail infrastructure, there's road maintenance, a broad infrastructural investment that's required. And then just lastly, to highlight the current challenges in the horticulture sector. I think those came out clearly, but as I've said, this is a sector that employs much of our agricultural labor force. And to ensure that those are sustainable is critical also to keeping those jobs. Thank you.